Hello, and welcome to the May 2024 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, presenting solo today. Mark is enjoying some time off up at the cottage. Today, I will be going over model portfolio performance as always, and then quickly talking about a characteristic of how your portfolio is built, and that is that it's a global portfolio and what global means, and why it's important for you to have global exposure despite very strong performance from US stocks. So let's get started. So over the past month, stock markets in North America and Europe are up around 1 to 2%. And the bonds in your portfolio, they're up around 0.5%. So not a bad month. We were on pace for even better numbers, but the last week of May saw some pretty hot inflation numbers again out of the US. And this data dragged down all the world stock markets. So far, though, we talked about company earnings last month. So far, company earnings have remained relatively strong, and many companies are using their added margin because they've gotten such strong earnings to now do things like buy back stocks, which further drives up stock markets. So far as we get closer to the midway point of the year, things are looking pretty good. The first row shows the year-to-date numbers after all fees, which is here. You've got the very conservative up around 2.59%, the conservative portfolio up around 3.72%, the moderate portfolio up around 5.53%, and the growth portfolio after all fees up 7.21%. I don't see why this performance can't continue for the next 7 months. So on to why global. Well, here is an interesting visual that I found on the growth of about $1,000 by various equity markets over the past 5 years from April of 2019 to April of 2024. So as you can see, there's a large dispersion in the performance of various domestic stock markets. The Nifty 50, which is the 50 largest companies in India, here, it's at the top in orange. That market is up about 92% in 5 years. The Nikkei in Japan in pink, here, it's up just over 72%. The S&P 500 in the States, it's up just over 70%. The TSX in Canada, yellow, it's up around 31%. The FTSE 100, the 100 biggest, largest companies in the UK, it's up around 10%. And the Hang Seng, which is the South Korean stock market, it's down 40% and experiencing major issues related to an aging population and those demographics, cost of living, and unfortunately low birth rates. So why am I showing this? Well, it's because it would be easy to take a look at this and say, let's go all in on Japan or let's go all in on the US, because look how well they've done and look how much momentum they have. But that would violate one key investing principle, which is recency, or known as recency bias. But more importantly, Mark and I have no idea if today is going to be the day going forward another 5 years that these numbers revert, and perhaps the UK and, say, South Korea, those are the markets that are the ones to outperform. Nobody knows, regardless of how smart they are. Here's an example of this playing out again. Here's a look at the S&P 500, the 500 biggest companies in the US, and the TSX, which is the Canadian Stock Market Index, over about a 25-year period from 1990 to 2014. You can see that there are two very distinct periods. In the 90s, you can see the US S&P 500 black line here, greatly outperforming the Canadian market in red. But in the 2000s, the S&P 500 ended the next 10-year period, so the 2000s, the next 10-year period, down with a negative return significantly. So if you were an investor and you went all in on the US equities by way of buying the S&P 500 in the year 2000, it would take you almost 15 years as you can see here, to get back to even. And over that time frame, what did the Canadian market do? Well, it would have significantly outperformed you. So that's why if you're in one of our models, which now 90% of all clients are, your average stock market exposure looks something like what you see on the screen. So you've got around 40 to 50% in the US, you've got around 15 to 20% of Canadian stock exposure, you've got around 15 to 20% of international stock exposure, which is Europe and Japan, and you've got around, 0 to 10%, closer to 5 to 10%, I would say, in emerging market stock exposure, which is China, India, Brazil, etc. Each of these markets brings something different. So if, say, the US is about to experience a period of outperformance or underperformance, should I say, it's highly likely that your exposure to Canada, international, and emerging markets will benefit you, as those markets will be the ones to outperform. And that's why Mark and I build all clients like you a very diversified portfolio that has exposure to many geographies like what you see on the screen. This is what academia and the math supports as delivering the best risk-adjusted returns. And it's also what I happen to do with my money. And that's it for this monthly update. It's a short one. Thank you so much for tuning in and listening to our update. Hope you have a great month of May, and I look forward to delivering our next monthly update to you next month. Thanks and take care.